So you've been thinking about buying an investment property, but you're wondering how exactly do the numbers stack up? How much is going to be coming out of my pocket each week? And how much money am I going to make over the next 5 or 10 years? Well, you've come to the right place because today I'm going to give you a case study of what actually happens when you buy a property of, say, $500,000 in value. What are the costs that are expected to purchase that property? And what is your position going to look like potentially at the end of 10 years? Before we get started, I want to let you know that the advice provided today is general in nature and it doesn't take into account your individual circumstances. So always get professional advice before making any decisions. But I certainly believe that today will give you some insight as to how property investing works. And please like, subscribe, or follow so you can get all of the latest hot tips for investing in property and securing your ideal home. So let's jump straight into it. And along the way, if you have any questions come up, if you want any more clarity, feel free to pop it into the comments. I promise I'll get back to you with any comments or questions that you have. And I always love to interact with people that are watching this video. So let's jump in and take a look. I'm just going to bring up a screen. So this is a typical property that people are buying right now. So this house is actually in a suburb of Perth and it has a sale price of about $500,000. It's a 4-bedroom by 2-bedroom. As you can see, really great value if you compare it to other cities around the country. But say you were to buy this as an investment property, then you're going to be up for costs of about $20,000. So that's going to cover your stamp duty and also your conveyancing costs as well. In the current market, a property like this would probably fetch about $550 per week, which gives you a yield of 5.7%. And at the moment, we are seeing some properties that are having yields of 6 to 6.5%. So I have been fairly conservative in these numbers just here. But yeah, you can see that, like, strong cash flow for this property. And this does depend on your location as well. So at the moment, WA has some of the strongest yields in the country, hence why there's a lot of investors attracted to this region at the moment. But if you buy the property in a bigger city, such as Melbourne or Sydney, you might find that your yields are a little bit lower. So how do you actually fund this property? Well, typically a lot of investors, they choose an interest-only loan for the benefit of your cash flow. And at the moment, the current rate that you could get is around 5%. It may increase a little bit with the interest rate changes, but 5% is a typical investment loan rate at the time of recording this video. So say we've got an 80% loan to value ratio. It means that 80% of the funding is from the bank and then 20% is from your deposit. So that means you require a $100,000 deposit and about $20,000 in buying costs. So it means you'd need about $120,000 in equity or cash to make this purchase. What I mean by in equity, so if you already owned your family home or you have maybe another investment property that's increased in value, it is possible to take money out of that property and then use this to buy another property. So you can basically do that without any cash whatsoever. It's just by approaching a mortgage broker or bank and then having the loan rewritten to take that cash out of that property that you already have. The other option is if you can't afford the 120, you can go for a 90% loan to value ratio. This means that it's a $50,000 deposit, $20,000 in buying costs, which means that you need about $70,000 in equity or cash. However, just noting that for this, it would attract a lender's mortgage insurance, which is not a bad thing. It is meaning that you can get into your property sooner. So it does give you that advantage. There might also be some tax deductions on that. So speak to your accountant about whether you can deduct the lender's mortgage insurance. So if it means you're getting into a property quicker, it may be worthwhile paying that cost. There is also some occupations where you can get exemptions from lender's mortgage insurance. So if you have any questions about that, feel free to reach out. There's a lot of different occupations such as doctors and accountants who actually can bypass that requirement. So once you got the funding for the property, you're going to purchase the property and then you're going to have your cash flows. So just here you can see that year one. So when you buy this property, once you take your income of $550 per week, take away all your expenses, and in this calculation, I have included your insurance, your agent management fees, your rates, and any other council fees. So that's after all of those costs. So after that, before tax, it's a cost of about $13.50 a week to hold this property, which isn't really a great deal, is it? It's literally a couple of coffees a week and you can own this property. However, the advantage of having a newer property is that you can get really great depreciation. So for this property, if you had a depreciation schedule put together, you can probably claim about anywhere from $10,000 to $14,000 per year in depreciation. And depending on your taxable income, it means that after tax, you'll actually get positive, it actually bring in money each week. So $34 per week, cash flow positive on this property. And that does take into account your deductions. So there is ways you can actually pay less tax week by week by lodging a form with the ATO, meaning that this is actually cash that you receive each week rather than waiting to the end of the financial year and claiming your deductions on your tax return. So after 10 years, assuming we have standard CPI at the moment, CPI is very high, but say we have fairly standard CPI, roughly 3 to 4-ish%, then what you're going to have happen is the rents are going to increase over time. Then at the end of the 10 years before tax, you're going to have $197 per week in cash flow positive income from this property. So that's just from one property. So $197. So literally not costing you anything. You may need to do some maintenance, of course, but generally it's going to be cash flow positive after the 10 years. But then, of course, you then have to start paying tax depending on your tax bracket. So after tax, if you're on a kind of a standard income, then you'll have about $149 per week after tax. However, cash flow is important and it's really great that you're able to cover your expenses and have a bit of money in your pocket at the end of the week. But where you really make your money in property is through capital growth. So if you take a look at this property, you can see that at the end of 10 years, this property is going to be worth about $814,000, which is based on a 5% growth rate. And 5% is fairly conservative. The average growth for a property in Australia is 6.8% per year. So if you base it on 5% growth per year over 10 years, then your property will be worth $814,000. So that's an increase in value of the asset of $314,000 or roughly $31,000 per year. So really, this is how you make money in properties, by buying it and holding it for the longer term. And that's where you're going to see profits from your purchase. So I don't know many other occupations where you can kind of buy an asset and sit back and then literally earn half or a third of an average salary just by holding a property. So you got one property, fantastic. What do you do next? Well, a lot of property investors, they tend to go for this buy and hold strategy, which has a number of benefits, particularly the fact that you can grow your wealth through accumulating extra properties. You can also have tax benefits, and it also avoids paying capital gains tax. So when you sell a property, there's taxes that you pay. So by holding the property, you're not going to have those expenses come up. So say you purchase property one and then it's grown by 15%. So you give it 3 or 4 years, and I mean, during COVID, it increased 15% in 1 year, but let's say in 3 to 4 years, it's grown by 15%. The property is now going to be worth about $575,000, which means that there's $75,000 in equity in that property that you've achieved. What you do though is you take the value of the property up to say 80% LVR, which means that at an 80% LVR, you're going to be able to take $60,000 of borrowable equity out of that property to then fund a new purchase. So say over the 3 to 4 years, you've been able to save $10,000, then that's going to mean you can purchase property number 2, which is a 90% LVR, $50,000 deposit, and then a $20,000 in buying costs. So $70,000. So your $60,000 plus your $10,000 in savings, you can then go on to purchase property number 2. And then again, wait over time, and then potentially go up to property number 3, 4, 5, 6. It's unlimited. The only thing that you are limited by is the growth in your first 2 properties. So when your property grows, you can take the equity out. So if they don't grow, then you won't be able to take equity out. But if they do grow, fantastic. The other thing you're limited by is serviceability or borrowing capacity. So the banks will look at your incomes and also your expenses, and they want to make sure you can cover all the costs of holding the properties and also your lifestyle as well. So the banks may put a limit that once you've reached property number 2, that you're not able to obtain any more finance due to your borrowing capacity. So that's why it's really important that the first 2 properties that you purchase are the right properties in the right location that give you firstly good cash flow, but also good capital growth. But you also want to make sure that your income and your expenses are managed so that when you present the case to the bank, they're more likely to approve your situation. So that's the buy and hold strategy, and that's how people jump from property 1, 2, and 3 in a nutshell. This is a very brief run through of how it works. Always happy to help people if they want more clarification and guidance on how they can achieve this and move on to grow their portfolio. But I do want to point out this little point here. So in Australia, about 2.2 million taxpayers, they own one investment property. And just think the population of Australia is 26 million people. So just 2 million people have an investment property or one. And then just under 400,000 own a second investment property. So quite a significant decline there. And then people owning 3 or more, that then drops again to 215,000 taxpayers. And again, the reason why this happens is firstly, they're limited by the growth in their first or second property and their borrowing capacity, or maybe they've been burnt or they've made the wrong decisions and they've been turned off, or maybe they simply don't have the motivation to go on and grow their portfolio, or maybe they don't know how to. So that's why it's important that you have a longer term plan when you're looking at creating your portfolio, so you know what steps you need to take to grow your wealth and to achieve your financial goals, whatever that might look like. Well, this has been a really quick run through of how buying an investment property works, how you can make money from investment property, and how you can grow your portfolio using the buy and hold strategy. Again, if you have any questions, pop them in the comments, and I'd greatly appreciate if you could follow, like, subscribe, so you can make sure you get the latest hot information so you can improve your knowledge and your mindset in being a highly effective property investor. I'm Steve Williams. I'm a licensed buyer's agent and property personal trainer. Feel free to reach out if you have any questions, and all the best in your journey in investing in property.